Hi there, the Wealth Coach checking in, and today we're talking about investments. And I know, because I've said it more than anybody, investments is just a teeny tiny part of the whole financial planning process. But because your friends are talking about it and because it's in the news all the time, it is something that we do have to address. Last time we introduced two new concepts, the risk spectrum and the return risk ratio. Today we're going to introduce one more new concept, and this is a very important one. It's called risk perception. But first, a quick review. The risk spectrum is just a benchmark under which you can place the risk profile of your particular portfolio compared to whatever else is out there. The safe side of the risk spectrum with a standard deviation of 2.5%, or way over here at the risky side of the risk spectrum with risk factors or standard deviations of 30 to 35%. Most portfolios are right about here at a 20% risk factor. The other concept was the return risk ratio, because risk in and of itself doesn't mean much. It's all in relationship to how much return are you getting for taking that risk. And we like to see a return risk ratio of about 1 or higher. Most portfolios, at least in our analysis, they are around 0.25 or 0.3. So there's some room for improvement there. The new concept, risk perception. And this is really important, because risk perception drives investor decisions, which drives investor results. Risk perception is based on what's been happening over the last several months, because as humans, we take whatever has happened in the last few months, in the recent past, and we try to extrapolate it into the far-flung future. So for example, when the markets have been going up consistently for quite a while, then our risk perception drops. Meanwhile, when the markets are crashing, our risk perceptions go through the roof. Back to that risk spectrum, here's your risk reality. This is where your portfolio really is, and it doesn't shift much from time to time. But your risk perceptions do, because when the markets are going up, your risk perceptions start shifting down this way. You may think this is where your portfolio is, but this is where it really is. And that's a problem. That's a big problem. And when the markets are crashing, here's where your risk reality is, but your perceptions go right through the roof. And that's also a problem, because you start making decisions that are emotionally based and not rational. And they have a tendency to cost you big time when it comes to performance. Dalbar's done lots of studies on this, and the average mutual fund investor trails the market by somewhere between 6 and 10% in performance. That's per year. That's pretty significant. So we have this concept of risk perception, and it is an issue. How do you manage it? Well, there's three ways to manage it. The first one is just to become aware of risk perception, that it does drive your investor decisions. Once you are aware of it, it's less likely to have an effect. So I hope that you can share this video with your friends and family members so they can become aware of what risk perception is, and hopefully their decisions will be better because of that. The second way is to just have benchmarks under which you can identify your risk reality. Remember that risk spectrum, here it is. Right? Your risk reality is here. By having that and knowing that that's what the real risk of that portfolio is, you will make better decisions, because it'll be consistent rather than fluctuating based on what the market's doing. And the third way is to hedge the portfolio. There are lots of ways to do this. Investment advisors will hedge portfolios by adding asset classes that don't correlate. We use in our firm more sophisticated hedges, including derivatives like options and futures contracts. And we can really dial down the risk without dialing down the returns. Again, we're going for return risk ratios of 1 or higher, and we're pretty close to achieving that. Not everybody can say that. If you have questions about all this stuff, and I know it's complicated, but it is important. If you have questions, please feel free to call me or send me an email, and I will respond to them. This is John Buerger reminding you, get control over your money before it takes control of your life. Thanks for watching this video.